A very good morning, friends. I hope you're doing good. And as I always keep saying at the beginning of the class, the expectations is that you have made your cumulative revisions on the financial instruments. So today, if I rightly remember, is the sixth session on financial instruments. We're almost like 50% through. Oh my God, 50% through with so much technicalities and more to come. But it's interesting. The journey is interesting on financial instruments. Now, before we take the inputs forward, let me just remind you and make some quick mind map on the learnings, what we did in the previous session, which is very important. And today we're going to see the practical applications of the learnings which we did in the previous class. Our basic focus is now on Index 109, where we're focusing on the holder's perspective. That means accounting in terms of financial assets. And we've also made it clear that financial assets are going to be measured initially at a fair value, with the two exceptions which we've got: trade receivable and loans which are recoverable on demand. And when it comes to the subsequent measurement, I give you a three-step model which is based on a risk assessment, evaluating the CCFC comprising SPPI test, evaluating the HFT held for trading test, and evaluating the BM, that is the business model test, and which leads us to the inputs that measurements could be on amortized cost or on a fair value through OCI. R&R depends upon debt equity investments and FVTPL. So I think let's make a quick mind map on the basic thought process. Which permutation combinations are we going to account the financial assets at which model? The logics are already there with you. I've already covered a total of 3 charts with you. I'm just going to pen down the thoughts. So let's make a little quick learning on the previous part and just make a quick mind map on the learnings. So as I said, the focus is in terms of financial assets measurement. So we are focusing on the accounting of financial assets. And whenever you think of the measurement of any asset for that matter, be it financial assets or be it any other standard, your focus always comes on initial and a subsequent measurement. So you should keep yourself absolutely clear that initial measurement is going to be at a fair value. And as far as the subsequent measurement is concerned, we have decided based on a 3-step model that what measurement base would apply. So first of all, we also remind ourselves that there are certain exceptions where we will not consider a fair value, but we're going to consider the transaction price. And the 2 exceptions are trade receivables as well as a loan which is recoverable on demand. So these 2 cases we'll be capturing things at a transaction price, not at a fair value. So we have to also take you to the inputs. If the transaction price and the fair value differs, what do we do? That's also going to be the focus today. When it comes to the subsequent measurement, we broadly divided the financial assets into 2 categories. One is what we call debt investments, and the other one is what we call equity investments. I'm not talking in terms of derivative investments. That I think one would easily remember that derivatives are always accounted at a fair value through P&L. Derivative accounting is simple, no questions put across, simply FVTPL. Now, when it comes to a debt investments, we can say we've got 3 inputs. So debt investments would be 3 inputs, and this is number 1. It's either at amortized cost or it is at fair value through OCI, which is R, and it is FVTPL. And I think broadly you need to remember that when I'm looking at debt investments, I have in my mind those investments which are FL for the issuer. Let's not get into CFI at this stage. So we're looking at those debt investments which are financial liability for the issuer. So in those cases, it all depends upon the business model. So when you say the objective is to hold it till maturity, when you say the objective is dual, either we're going to hold it till maturity or we're going to sell it at the earliest opportunity, then it is FVTOCI. And in this case, if the objective is trading, then it is FVTPL. So these are the three broad categories in terms of debt investments. And similarly, when we look at the equity investments, there are two broad categories of equity investments. One is that you take the equity investments at FVTOCI, and that is NR. And that is NR. And remember, equity is always with no reclassification and debt is always with a reclassification. We made some clear-cut distinctions between the two as well. I'll just remind you. And the other one is supposed to be FVTPL. By default, this is the category. By default, as far as equity investment is concerned, it is FVTPL. Unless we are clearly given, a company is chosen the irrevocable option of considering the equity investments at OCI. This goes by default because this is available, the choice is available only when it is not held for trading. Because if it is held for trading, it is undoubtedly FVTPL. If it is not held for trading, then it is either FVTPL or FVTOCI. And what you need to remember, the most crucial aspect is regarding this concept of debt equity investments, that is R, and what is the concept of equity investments, NR. Now, there are three things which you need to definitely keep in mind. When you look at equity investments, that is NR, no reclassification, whether it's a gain, whether it's a loss, whether it is realized or it is not realized. Now, don't take this as R as reclassification and NR as no reclassification. This is realized gain or loss, not realized gain or loss. So everything in this case enters the other comprehensive income. That's the most crucial point you need to remember. That in terms of equity investments, the standard setters have a very clear-cut objective in mind. There is a realized gain loss, there is an unrealized gain loss, nothing goes in the P&L. Everything is captured in terms of equity. Sorry, I think I put that equity. I guess, let me just change this. This is equity. So this is in terms of the equity investments which I mentioned. So in terms of the equity investments, whether it is realized, whether it is unrealized gains or losses. So you've got realized gain, you've got realized loss, everything enters the OCI. So equity investment is one of the beautiful categories made by the standard setters. Nothing enters the P&L, except, of course, if there is any kind of, let's say, dividend income that enters the profit and loss. But other than that, any fair value changes will go to the OCI. Gain, loss, I don't care. You sell the investments, realize gain, loss, I don't care. It all goes in OCI. But in terms of debt investments, we make a distinction that if it is unrealized, then the accounting is different. And if it is realized gain or loss, the accounting is different. The unrealized gains or losses are taken in other comprehensive income, and the realized gains or losses is taken in the profit and loss. That is one area of distinction which you need to be very clear. The debt investments, the gain is realized or unrealized makes a difference. In terms of equity, it does not make a difference. And of course, the second difference, which is in the nomenclature, reclassification means accumulated balance will be taken in the P&L in the year of sale of the investments. And when I say NR, no reclassification, accumulated balance is not going to be transferred in P&L, but is going to be shifted in the tab number 2. The amount which is in tab 3 is going to be directly shifted in tab number 2, retained earnings. So this is, I think, a basic structure which we, made our inputs on. Now what I'm going to do to begin with simple little inputs, we're going to do 5 questions, rather I would say 5 cases. And then I'm going to make a chart which will summarize the accounting of all these permutation combinations. So what we're looking at is accounting for debt investments AC, OCI, P&L, 3 cases. Equity investments, OCI, as well as P&L. So once we're done with these 5 cases, we're going to see the inputs from initial to subsequent measurement. Once we get the entire parameters, we're going to put that all in the chart. And then we'll start working on the second area, which is when you capture things at a fair value and there is a difference in transaction price and a fair value, how do you account for the difference? Our total devotion is going to be on the financial assets. We're going to do a deep dive in terms of financial assets, initial to subsequent accounting, and also considering that if there is a difference in the fair value and a transaction price, how it is to be accounted for. That was a quick summary of the inputs. Now I think let's go ahead. So I'm going to start my journey with these 5 cases to begin with. Okay, so I am just going to share a small little question to you at this stage, and we are going to follow that particular question. So I'm just going to share something on the screen maybe, and we are just going to walk through debt investments to begin with. So I'm going to give you the data as far as the debt investments are concerned. It's a good question which is going to give us a good insight. I've already done, I guess, one of the cases in this question with you when I was explaining the concept of amortized cost. Now please have a look at the question which is on your screen. It says on 1st January, and I would advise you maybe take a snapshot, just, take a control window screen and just take a snapshot of this question because I'm going to work on this question for my 3 cases. It says on January X1, Tokyo bought 1 lakh 5% bond for 95,000. I think if you remember, we did this question earlier when I was explaining the concept of effective interest rate. And I said, this is what is called accounting at amortized cost. So we've already done this input. It says Tokyo bought 1 lakh bond for 95,000, incurring an issue cost, which is called a TC, which is called a transaction cost of 2,000. The interest is received in arrears, that means at the end of each year. The bonds will be redeemed at a premium 5960 over and above the face value on December X3. Now, I think I'm going to recreate the statement which I made earlier. And I think I'm going to put that statement again to get the vouching done. Can I see if I see any one of the 3 elements? Mind the words very carefully. If I see any one of the 3 elements in the question, whether it is a discount, whether it is a premium, or whether it is an issue cost called a TC, can I say this will trigger the need of calculating the EIR? The contracted rate of 5% would definitely not represent your effective interest earnings. Is my thought correct? The moment you read a question, I'm saying the moment you read the question, you look at the words discount, you look at the word premium, you look at the word TC, any one or all the 3, it should give you in the mind EIR is certainly different as compared to the contracted rate of interest. Do you vouch me on this? Because we were talking of this earlier as well, the same example we've spoken earlier as well. So, do you agree with this? Let's see if your statements are on agreeable trend on this. And yes, I get the answer. Issued at a discount, premiums, yes, EIR is needed. That's wonderful indeed. Great. And then the effective rate of interest is given. And I already said that you can calculate this EIR also by calculating the internal rate of return. Then I'm given the fair value of the bond. And then there are 3 requirements, 3 cases, so 3 requirements. Let's see one by one. Explain with calculations how the bond will be accounted for all the relevant years. If the business model is to hold the bonds until redemption date, would you like to give me the measurement base? If the objective is to hold them till redemption date, that means it seems that they will be kept till maturity. And if they're going to be kept till maturity, I think we can decide it becomes a case of amortized cost. That's rightly said. Wonderful indeed. Then he says the Tokyo's business model is to hold the bonds until redemption, but also to sell them if the investments with high returns becomes available. It seems that there is a dual objective. The investor in this particular case is either going to hold them till maturity, or he may sell them if high returns becomes available. So in this particular case, a dual model would mean FVTOCI, and if it is a case of a debt investments, wonderful, it is R, good. And then it says Tokyo business model is to trade them in a short run. When you say you're going to trade them in the short run, undoubtedly means trading, it means FVTPL. And then it says, assume that Tokyo sold this bond for the fair value on 1st January X2. Okay. Now watch this carefully. As we do all these cases out here, you will get a complete clarity of thought. So I'm going to go one by one and we're going to do 3 cases. So right now the concentration is on these 3. Then I'll take maybe the same example to run through the FVTPL as well. Then once the base is formed, we're going to create a chart and do some questions in the study material in unit number 2 as well. Let's begin the journey. So I am first of all taking this question and taking this as a case number 1. This is the case number 1. It is a case of debt investments. And this is measured at AC, that is amortized cost. So let's see, first of all, I think we've already seen that ledger, but to just, go with the flow, I am going to first make a account at financial asset account. I always prefer to make a ledger account instead of making an amortization chart. Many places you will find that, people create what is called an amortization chart, but I prefer to make a ledger. And I always tell people, it's good to make a ledger because the calculations will get eased out easily. We used to that, in our school and colleges as well, NNCA. So I think that's going to be an easy task. Now, first of all, we record the initial recognition. So we made an investment in this bond at 95,000 and the TC will also be added. Mind you, in all these 5 cases, I will tell you the treatment of TC. So think carefully, then we'll make a chart in the end. So in terms of AC, the initial recognition will be inclusive of the transaction cost incurred. So we invested a total of 97. The logic is fairly simple. What you used to do earlier, even in terms of intermediate, that if there is any brokerage and commission given, it's a part of the acquisition cost of the investment. So in this case, the transaction cost incurred has got added and this TC becomes a part of the carrying value of the investment. Now what we're going to do, we're going to attribute a finance income, which is at the rate of effective interest rate, 8%. Because we decided interest is not what you're actually receiving. Interest is what you're effectively receiving. So let's take an 8% interest on this. So on 97,000, 8% comes to 7760. And this is what is going to be taken in the credit side of the profit and loss account. Then at the end of the first year, you're going to receive the interest on the face value. 1 lakh is the face value of the bond and there is a 5% contracted rate. So we capture 5,000. This is the amount received, collected. This is not the income in the P&L. Let me again remind you, when you go to capture the income in the profit and loss, this is the finance income which will be captured in the profit and loss of the company. So let's take a balance CD as a balancing figure. So in terms of amortized cost, just to remind you again, we're not considering any fair value. The concept of amortized cost only captures the interest income on effective rate, but there is no concept of fair value changes to be captured. So we take a balance CD as a balancing figure. And I think that's 99,760. So we take this as the opening balance in the next year. That's 99,760. Again, we take finance income at the rate of 8% on this. So let's see, 99,760. 8% would mean 7,981. Then again, you receive that 5,000 coupon rate on the face value, and you get the balance CD as a balancing figure. As simple and as straight. So 99,760, 7,981. This is 102,741. This is 102,741. And we've already made this ledger earlier. When I was explaining the concept of AC, I've already done that earlier as well. So let's take the balance BD, 102,741. Last year, I'm not calculating the finance income. I'll take it as a balancing figure just to get some accurate results. And now in the third year, which is the last year, you receive the interest on the coupon rate and you get the face value plus the premium, that is 105,960. And you can comfortably take the finance income as a balancing figure. And this works out at 8219. This is the finance income. I don't see that there will be any challenge in terms of the case number 1. So in this particular case, what we have done, we've just attributed the finance income at the rate which you're effectively earning each year, and that enters the P&L. So far, so good. Any challenge on the case number 1? I think we are clear. We can go to the case number 2. Now that becomes interesting. Okay, so far so good. I guess everybody's clear with this inputs now. We're ready to go to the case number 2, I guess. So I am going to the case number 2, and this is a case of debt investments, and which is carried at fair value through OCI. And it is always a case of R. Debt investments is always reclassification. Okay, so far so good. Now friends, hear me carefully. When I am considering FVTOCI, I need to consider the calculation of the interest on EIR itself. I don't know why, but I've seen many people tend to consider that the interest in terms of AC is an EIR. That's it. No. The calculation of EIR is applicable. Please hear me carefully. The application of EIR is applicable to debt investments, not equity. Yeah, that is one thing which you need to keep in mind. The concept of EIR is applicable to debt investments, not to equity investments. But then in terms of debt investments, it applies only when it is AC or OCI R, not FVTPL. So even if you take your debt investments at FVTPL, the concept of EIR cannot apply. The concept of effective interest earning is applicable only when it is debt investments, one, at AC as well as OCI, that's it, not FVTPL. So even in this particular case, as we make a ledger account, the concept of EIR is going to be applicable. So let's see the financial assets. The initial recognition again is going to be at the same figure. You made an investment of 95 plus a TC, that's 97. So one thing which is common here, that the TC is got added to the initial recognition. In terms of AC as well as OCI, the TC is got added to the initial recognition. The finance income will be taken at the rate of 8%, which you can take from the previous ledger. And that's 7760, so that remains the same, no change. You receive that 5% coupon rate, there is again no change. So you can see till now, in this particular ledger, there is no change at all. So what you did in terms of AC, we're exactly done the same thing. The only change comes at the end of the year, that now you're going to consider the fair value. And I think I gave you the fair value, that the fair value at the end of the year is supposed to be 1,10,000. So in this particular case, when you take the balance CD, you are going to consider 1,10,000, which is supposed to be the fair value. Unlike AC, where you took the book value, that is the balancing figure. Trust me, the only difference in AC and OCI, in AC, the fair value change is not captured. In OCI, the fair value change is captured, rest the accounting 100% is same. In both the cases, TC is added to the initial recognition. In both the cases, the concept of EIR is applicable. The only difference is AC, the fair value change is not captured. FVTOCI, the fair value change is captured. Now, would you like to make a guess? Where will you capture the fair value change in this case? Since we are considering FVTOCI, so any fair value changes at the end of the year is going to be taken where? I'm sure you can define that. Where will we capture the same? And that's right, it goes in the other comprehensive income in this case. So let's see what is the balancing figure. So 97 plus 7760. And if you compare this, I think we're getting a difference 10,240 on debit side. So there is a balancing figure 10,240 coming on the debit side, which is OCI. That's a gain. That's supposed to be a gain. And this is going to be accumulated in the tab number 3 as far as statement of changes in equity is concerned. So this amount is going to be accumulated in terms of the tab number 3, and it will rest there. Once we sell the investments, that money goes in the profit and loss in that year. Okay. So we can take the balance BD as 1,10,000. Now you need to be careful. Now you need to be very careful. In the next year, when you take the finance income, please don't take it on the balance BD. The finance income calculations are going to be based on AC. Sir, how would we do that? Well, indirectly, you made a leisure account for AC. Keep picking up the finance income from those leisure. So that means, are you trying to tell us that if we get a question on AC and OCI for running years, you need to effectively make a working note where the finance income on AC is available? Indirectly, I'm saying yes, you heard me correct. Because the finance income to be captured in terms of other comprehensive income is the same which is captured in terms of AC. So if you get a leisure for an OCI, at the end of the day, you need the calculation of finance income based on amortized cost approach. So I think I would suggest the easy way to do out is you make your leisure account based on AC. That becomes a working note for the calculation of the interest for OCI leisure as well. I hope I stand very clear on my thoughts. That when you're considering the interest income in terms of OCI, you need in the background a amortized cost leisure as well. Because every time I'm going to pick the interest, I'll pick it from the AC leisure. So the interest in the second year is 7981. So I think let me just highlight this point as well, that this finance income is supposed to be same as AC leisure. This is the same as the amortized cost leisure. You cannot afford to take the interest income on 1,10,000. So remember, that is a crucial point. The finance income in both the cases is the same. Whether it is AC or it is OCIR, the finance income is common. Then we go and capture the receipt of that 5,000 coupon rate. The balance CD in this case is not the balancing figure, but is going to be again the fair value at the end of the year. So the only change you can see is getting the fair value instead of taking the balancing figure. Rest everything is exactly the same. So I gave you the fair value in this case. I think that was coming to 1,04,000. So this works out at 1,04,000. Let's see what is the gain or loss which will be captured in the OCI. So let's see what is the balancing figure, and that would be the fair value gain or loss in this case. So I think this time it's coming on the credit side, I guess. This is 8981. And this is also going to be taken in the OCI. Now, this time it is a loss. This time it is a loss. Okay. So this is giving me the capturing position of the fair value changes getting accumulated in tab 3 of SOCI. Let's go ahead and let's take the balance BD again. This is 1,04,000. Here again, I cannot afford to take the finance income on this money. The finance income again is going to be the same which is taken in the amortized cost ledger. So let's go back. That is 8219. So we capture the finance income 8219. Now, in this particular case, let me tell you one thing so that there's no confusion later. Now, you need to watch this carefully. In the second case, the objective is to keep it till maturity or to sell it when the opportunity arises. Now, I'm making a ledger account on the pretext that I never sold the investments. I'm making a ledger account on the logic that I never sold the investments. If I never sold the investments, therefore you would now see that I'm making the ledger till the end of the third year. Because I have made a ledger on the logic that, we had an opportunity of sale or maturity, but I did not sell. So at the end, I kept it till maturity. So I'm going to get that 5,000 coupon rate, and we're also going to get the maturity amount as well. Now let's see what is the balancing figure in this ledger. That would also represent the gain or loss, the fair value gain or loss, and I think it's coming to 1259. This will also enter the OCI. That's a loss accumulated in terms of tab 3. Now, friends, you need to watch this carefully. Okay, I think I missed a particular question. So why cannot we apply FVTPL case of debt instruments EIR? Well, when you consider the case of a debt investments which is held for trading, the objective is not at all to earn interest income. We need to appreciate the concept of calculating EIR is where the objective is to keep it till maturity, where the objective is either to keep it to maturity or sell. There, the objective is to earn the interest income. But when you're holding the investments for, the purpose of trading, we are not even close to the objective of earning interest. So why tell the company to capture interest on the effective interest rate earning? The calculation of EIR is based on the outflows and the inflows, which is going to flow till maturity. And in this case, if it is going to be trading, you might sell it in the next couple of months itself. So the question of telling the company to use an EIR would not make any logical sense. I hope you got the answer. Therefore, the concept of EIR is limited only to those investments where the objective is to hold them till maturity, or maybe a dual objective of maturity or maybe sale. In those cases, EIR makes sense, but if it is trading, it doesn't make sense. Correct. Wonderful indeed. Okay, now another inputs at this stage to give you more clarity of thoughts. If you look at the status of the amount in the tab number 3, in the first year, we put a gain to the extent of 10,240. And in the second and the third year, we've taken a loss to the extent of 8981, and we've taken a loss of 1259. If you see what is the accumulated balance in tab number 3, see what is the accumulated balance in tab 3. So 10,240 minus 8219 minus 1259. So see what is the status in this case, 8981 and 1259. The balance is 0. So let me, ask you a question. Is this by chance a 0? The balance in the accumulated tab 3 is become 0. Is that a chance or is this got to be? Think. In this particular case, the company never made a sale of investments in between. They never sold of the investments in between. So can I say if they never sold of the investments, the unrealized gains or the unrealized losses never converted into realized gains and loss. So can I say at the end of the year, end of the day, if you look at the accumulated balances, if you land up holding it till maturity, can I say there has to be a 0 profit loss? because you kept capturing the fair value change, but you never sold the investment. So what was unrealized in the books of accounts never got converted to realized gain or loss. So by the end of the third year, this balance should become zero. But this will be possible only if you hold the investments till maturity. But if you sell them, of course, the unrealized gains and losses gets converted into realized gains and losses. Right, friends? I hope I'm making complete sense on the inputs. So this is the case number 2. Now, I don't know whether I should do that or not. Do you want me to show you in case 1 and in case 2? What is the profit loss if you sell the investments in between? Now, you would tell me, sir, in terms of AC, the objective is never to sell the investments in between. Then the objective is to hold it till maturity. Then how can you sell? Let me tell you one thing. Though the business model is to hold the investments till maturity, but let's say, for example, I am facing a credit risk from the other person. The credit risk means the failure of non-receipt. So if I'm fearing a credit risk from the issuer that is not going to give me interest or my principal money back, it doesn't mean that I'm going to hold the investments forever. I might even sell those investments in between. And in this particular case, when you apply the concept, it doesn't mean that whatever happens, you're going to hold the investments till maturity. If I'm running a credit risk, a deviation in terms of the fact I can sell the investments in between as well. Do you want me to show you a comparative position if the investment is sold in terms of AC, somewhere in between the second year maybe? And if the investment is sold in terms of OCI, you want to look at the impact on the profit and loss statement. If yes, I'll do it. If no, I'll not. So you want me to show you the comparative positions? I guess I am getting an answer. Yes, sir. We want to see that. Okay, so give you more power, to give you more clarity, let's consider both the cases and see the comparative position. Now watch this carefully. This is going to give you more clarity of thoughts in life. That if I were to sell the investments in terms of case 1 or case 2, let's say at the end of the second year. So I am now considering the case 1, which is a case of amortized cost. And I'm considering the case number 2, which is a case of FVTOCI, that is recycling. So let's assume that the financial asset is sold at second year end. So let's take the presumption that it is sold at the second year end. I want to now see something very interesting. Now watch this carefully. Watch this carefully. Now there are two elements which you need to evaluate carefully. The first element which is coming to my mind is that you're going to calculate the profit or loss on sale. And the second element is the accumulated balance in tab number 3. So there are two aspects which ones need to see carefully in terms of case 1 as well as case 2. Now, in terms of case number 1, let's see what is the book value at the end of the second year. Can I say the book value at the end of the second year is 102741? So the book value in this particular case is 102741. And I made a sale of this investment. Can I say this is at 1,10,000, I guess? No, 1,04,000. So we can see that the investment at the end of the second year, the book value in terms of AC is 102741 and the sale is made at 1,04,000. So let's see what is the profit or loss on sale. So we get a profit or loss on sale 102741 versus this, we get a profit of 1259. This is going to be captured in the profit and loss of the company. Simple and straight. Can I say in this case, there is no accumulated balance because there is no concept of tab number 3 in terms of AC, so that's not applicable. Now let's go on to the second year in this case. Now, before the second year, you need to consider that what is the book value? What is the book value of this investment, and it is sold at what figure? Now, please watch this carefully. At the end of the second year, the book value is, we will take the effective balancing figure. See this carefully, please. If I want to get the book value at the end of second year, in terms of OCI, you take this 1,10,000 plus 7981 and minus this 5. Get the book value. Get the book value at this stage. So if you want to get the book value, take this 1,10,000 plus 7981 minus 5. It's 112,981. This is 112,981. And you sell it at 1,04,000. And you sell it at 1,04,000. Remember, the book values in the ledger is different because you've captured the asset in the balance sheet. You've captured the asset in the balance sheet at 1,10,000. You took the finance income and the collections, so you get the balancing figure in the ledger before capturing any fair value gains or loss. This is the book value. So we are getting a loss on sale, and that is to the extent of 8,981. But then there is another input as well, the accumulated balance in tab number 3. The accumulated balance in tab number 3 is supposed to be 10,240 credit. So there is a total, you can say, credit balance in the accumulated tab number 3. And this money goes in the P&L, and this accumulated balance will also be transferred to the P&L. The accumulated balance in the tab number 3 will also be transferred to the P&L in the second year of sale. So this 10,240 also goes to the P&L on the credit side. Now, if you see the net position, at this stage, this is a credit in the P&L and that is a debit in the P&L. So 10,240 minus 8,981, the net credit is 1,259. And you can see it matches exactly with the figure that is 1,259 in this case. Which means now you can see that in terms of AC, once you sell the investment, you get a gain loss. And even in terms of OCI, when you sell the investments, you're going to get the gain loss, and the gain loss in terms of OCI as well as in terms of AC, 100% will be same. The only difference is that in terms of OCI, you are capturing the fair value change. In terms of AC, you're not capturing the fair value change. I hope that gives you more power to think. Got the clarity of thought, friends, on that? I think this was necessary to give you a comparative position of how the gain loss is computed as well. So I thought it's a good idea to give you the initial, the subsequent recognition, and also when you sell the investments, what is the status? Clear, I guess, with this? Okay, that's wonderful. All clear. Good. Wonderful indeed. Now let's go further. So this is the case number 2. Now we come to the case number 3. We're going to make a complete chart, a comparative one at the end after all the 5 cases done, so that you get a complete clarity of how the accounting is done in all the permutations and combination. Now let's go to the case number 3. Now in terms of the case number 3, we're looking at debt investments, and that is measured at FVTPL. So this is debt investments at FVTPL. Now, few changes to be incorporated at this stage. No concept of EIR. Now, there are 2 important things to be kept in mind. The first is that the concept of effective interest rate is not applicable. As I said already, the concept of EIR applies to AC, applies to OCI, but not to FVTPL. And to equity investments, a big no. The second is the TC cannot be added to initial recognition. The TC cannot be added to the initial recognition in this case. Unlike AC, unlike OCI, where the issue cost, the TC was added to the financial asset. In this case, it cannot get added. In this particular case, this transaction cost is immediately expensed to the P&L. It is immediately expensed to profit and loss account. So this cannot be added to the financial asset measurement. So these are the two main areas of distinction. So whether it was AC, it got added. It was OCI, it got added. In both the cases, EIR applied. Here, not added. EIR does not apply. Your mind should start working on the comparative treatments of all these different cases. Okay, so what I'm supposed to do is going to be simple. Let's make a timeline. Let's make a timeline so that we can look at a comparative position in this case. Though in this particular case, I'm given that I sold the investments at the end of the first year. I sold the investments at the end of the first year. So let's have a look. So we can say at time 0, when you made the investment, the entry is financial asset debit and the bank gets a credit. This entry will be at 95,000 only, not at 97. Not at 97. The 2000 TC cannot be added to the financial assets. So what we're going to do, we're going to put another entry. The TC, the entry becomes profit and loss debit and the bank gets a credit. So this transaction cost is immediately expensed in the P&L. Now, let's say at the end of T1, I'm given that the investment is sold. The investment is sold. So in this particular case, if you sold off the investments, I'm not capturing any fair value changes or directly sell off the investment. So what is the book value of this investment? The book value of this investment is 95,000 and the sale proceed of this investment is 1,10,000. So what is the profit on sale? That's 15. So we will put the entry bank gets a debit. That's 1,10,000. Financial asset gets a credit. That's 95,000. And the profit on sale 15,000. That amount is taken in the P&L. It's a realized gain. It goes in the P&L. Even if you don't sell the investments, the unrealized gains or losses will again enter the profit and loss. So even if you don't sell the investments, realized, unrealized doesn't make a difference. That all gain loss enters the P&L. The accounting becomes even more simpler. The accounting becomes even more simpler because TC gone to the P&L, EIR concept not applies. When you sold the investment compared, the book value and the sale proceeds and the gain loss goes in the P&L. As simple as that. Right, friends. So I think that gives me the insight in terms of 3 cases. I should now be clear. Accounting of debt investments AC, accounting of debt investments OCIR, accounting of debt investments at FVTPL. Wonderful. Now let's go to equity. So now I'm coming to the case number 4. I think let's take the data from this question. At least we can take the figures from this question, so there's no problem. So I'm taking the same data, but I'll give you the key points, what you need to connect it on. So now we're looking at equity investments. We're looking at equity investments at FVTOCI. That is supposed to be no reclassification. This is equity investments FVTOCI NR. Let's again see the inputs. Now, there are some crucial points which you need to keep in mind that when you do the initial recognition, what is done. So let me now add 2 important key points at this stage. Number 1, the concept of EIR is not applicable. In fact, let's put it like this. The concept of EIR never applies to equity investments. It is a concept which relates to debt investments. On equity, you get dividends, you don't get interest. So where is the question of getting an effective interest rate? So I think let's put this in journal. Let's put this in journal that EIR is not applicable to equity investments. So just to add on, we can say it applies to debt investments. It applies to debt investments and that also at AC, as well as FVTOCI, that is R. It applies only to, you can say, debt investments at AC or FVTOCI. So let's also add not applicable to FVTPL, that is debt investments. If you've got debt investments at FVTPL also, it does not apply. I'm just putting that in your mind so to be very clear on the thoughts that where it is taken and where it is not taken. Now, just to be on a very clear-cut category, let's take a timeline to understand the accounting in this case. T0 and this is T1 at the end of first year. And let me also give you the second point. TC is added. TC is added to financial asset in this case. Wow. TC is not added only in terms of FVTPL. TC is not added only in terms of FVTPL, whether it is debt equity investments. In all other cases, TC will be added. You take a debt investments other than FVTPL, add. You take equity investments other than FVTPL, add. So I think at this point, I'll also like to make, one input at this stage. That TC is not added. TC is not added for FVTPL category, whether it is debt or whether it is equity investments. In these two cases, it is not added. So your mind should be clear in terms of EIR applies when. Your mind should be clear that the concept of TC is added in which particular cases. Okay, let's now begin the journey. So in this case, the entry becomes financial asset gets a debit and the bank gets a credit. So would you like to tell me what is the figure at which you'll record the financial assets? What is the figure at which you're going to record the financial assets in this particular case? So think. As I said, that's rightly said, it's going to be 97,000 including the TC in this case. We added the TC in this particular case. Now let's say at the end of the first year, let's say sold off the investment. Let's say I'm assuming we sold off the investments in this case. If you sell off the investments, we can say what is the book value? 97. And what is the sale proceeds? It is 1,10,000. So let's see the journal entry. The entry in this case is bank gets a debit 1,10,000. The financial asset gets a credit, that's 97. And the profit in this case is realized. The profit in this case is realized. But I said for equity investments, no P&L. Realized, unrealized, gain, loss, all in OCI. So this amount is going to be captured in the other comprehensive income, that's 13,000. Even though it is realized in nature, that I think I've already given you earlier, that equity investments at FVTOCI, whether it is a fair value gain loss, whether it is a realized gain loss, all captured in the other comprehensive income. I hope I stand very clear on the fourth case as well, that is equity investments. Great. Let's go to the case number 5 now. Let's go to the case number 5, which is now the case of equity investments. And please revise these cases well. Once you look at the comparative position of how the accounting is done in all these 5 cases, trust me, you're going to get clarity. And I'm also going to give you a chart as well. So far, I think today you may not find things technical to begin with, because now I think the position would have slightly eased to my understanding. I think it may not be sounding that technical as compared to the previous parts. But yes, the levels will increase. But right now we are on a very moderate level of learnings at this stage. Now, in terms of equity investments, again, let's put the 2 points. The concept of EIR is not applicable and TC is not added. TC is not added on initial recognition. That is just a reiteration of what we said earlier, that initial recognition, the TC is not added. You know which cases it is added now. So in this case, again, we can say it is immediately charged. It is immediately expensed to profit and loss account. It is immediately expensed to the profit and loss account in this particular case. So again, for a clarity of thought, let's consider this. Let's make a timeline. Let's create a timeline to see the accounting for FVTPL T0, and let's consider T1. So we made the investments at the inception. Financial asset gets a debit and bank gets a credit. Would you like to tell me what is the amount of initial recognition? 95, or is it going to be 97? So in this particular case, what do we consider? 95 or do we consider 97? And that's right. I think I'm getting 97. No, this is going to be 95 in this case. Because in this particular case, the TC is not added on initial recognition. And of course, you're going to put the entry that is profit and loss gets a debit and the bank gets a credit. This is to the extent of TC, which is immediately expensed in the P&L. So you're going to see that the debt investments and the equity investments at FVTPL is not different. The accounting for debt and equity investments at FVTPL is absolutely same. So in this particular case now, let's say we sold the investment, the book value is 95 and the sale is at 1,10,000. So we can put the entry that is bank gets a debit, 1,10,000. The financial asset gets a credit at the book value 95, and 15,000 is the gain, which is going to go to the P&L, irrespective, realized, unrealized, it goes in the profit and loss account. Wow. I think I'm getting a question. So why there is such a discrimination in terms of the transaction cost in this case? I can give you a deeper logic for that as well. Why there has been a discrimination. I'll tell you. Just watch this in terms of FVTPL. Just watch the basic maths. You'll get some more logics. Imagine I would have captured this at 97. And then you would have sold the investments at 1,10,000. So what would have been the profit on sale? Can I say the profit on sale would have been to the extent of 13,000? Let's say, for example, I tell the companies, no problem, you add that 2,000 and then you sell the investments at 110. So what is the profit on sale? 13. Now I'm getting a profit on sale, which is 15. And that amount of 2,000 is taken to the P&L. But if you see the net impact, it is basically 13,000 gone to the P&L. Did you get the logic now? So even if you tell the company to, add it to the cost of the asset initially, it doesn't make a difference. Here you've taken the 2,000 in the P&L and then you get a profit on sale, which is 15. So 15 minus 2 effectively is 13. So even if you allow them to capture it initially, your gains would still remain the same. So what's a good point? Telling them that till the balance sheet date, you put it in the amount. If it is supposed to be investment held for trading, you're going to, in any case, maybe sell it within 1 year. So I think in that case, telling them to capitalize it as a part of the asset value would not logically make sense. But the interesting part is, in this case, it is entering the P&L. But in terms of OCI, the fair value gain loss goes in the OCI at the end of the year. The TC is indirectly entering the, you can say, OCI at the end of the year. In this case, you can see it is indirectly entering. Because when you take the difference of 97 and 110, this 13 is nothing but, you can say, the 15,000 gain and the TC got netted off as well. So in this case, the TC is technically netting off and it is entering the profit and loss account, getting in the OCI indirectly. So in terms of equity investments, you can see that this figure of TC is also entering the OCI at the end of the year indirectly. Because in terms of equity investments, the standard setters did not want anything to enter the P&L. The realized gain loss OCI, unrealized gain loss OCI, the TC also indirectly OCI. I hope you got the thoughts clear on that. Okay, so this is done. I guess now it's time to make some summaries in this particular case. I think all the 5 cases done. I think before we make a chart, or I think I should get your scores after the chart, right? Because once we are able to pen down all the thoughts in a single chart, then I think I'll get your comfort scores on a scale of 10. Let's now make a chart. So I'm going to summarize all these inputs to you. I'm going to summarize all these inputs to you. I think, let me just delete the slide in between. Let's add out here. So this will summarize the position in terms of comparing all the 5 kind of investments. Now, this chart which I'm about to prepare is a summary view of all the insights at one place. So when you revise all these 5 cases, you should be able to, capture the thoughts that, okay, in which case, what is done. If you're able to catch up with the almost, I would say 100% of this chart, your concepts are going pretty strong at this stage. Let's make a chart. So I'm making a summary chart. I'm making a summary chart of the financial assets accounting. So this is a summary chart where I am making the financial assets accounting initial and subsequent measurements, all the inputs put together. So we're going to look at things from the initial to the subsequent, all the parameters, we're going to put them at one place. Let's make some columns. So one column for the particulars, and then we've got 5 categories of investments. So one for AC, OCIR, FVTPL. So maybe we can take this, okay. Let's make it separately only. So let's consider this broader one. This is debt investments. And let's consider this as equity investments. So we've got AC, we've got FVTOCI, there is R, FVTPL, FVTOCI, there is NR, and there is FVTPL. So I think let me put some questions. You can answer them in between, and we're going to just pen this across all the thoughts in a single chart. So let's begin with the first input. I'm looking at, first of all, the initial measurement. I'm looking at, first of all, the initial measurement. Now, you need to give me the initial measurements, that is including, excluding TC. So I'm looking at the answers, which is with, without TC, whatever is done. Now, let's go ahead. So can I see in terms of ACOCI, is it right to say that it's going to be fair value plus a TC? Fair value plus a TC. And here it will be just fair value, no TC. Correct? I think that's rightly vouched. So we can say that we are very clear that when it comes to a TC, it's added in terms of these 2 categories. Can I say here also fair value plus TC? And here it is going to be fair value. So you can clearly see the comparative positions now. The TC is not taken only in this case. So I think just to put that mark very clear, so we can say these are the 2 cases when TC is expensed off. So that will give you a clarity of thought that in terms of FVTPL, whether it is debt investments, whether it is equity investments, the TC gets expensed. In all of the cases, it gets added. Let's go to the next one. Let's first of all also understand where the concept of EIR would apply. So let's consider where the concept of EIR in this case would apply. Can I say in terms of AC, yes, it applies. OCI, yes, it applies. Can I say it is not applicable in these cases? It's not applicable in these cases. So you can clearly see that for equity, it does not apply. And for debt FVTPL, it does not apply. So just to highlight the inputs, so we can say these are the three cases where the EIR is not applicable. Equity, undoubtedly no. And for debt investments, FVTPL, it's again no. Let's go to the next one now, the crucial point again. And the crucial point is we're looking at fair value changes that is unrealized. We're looking at fair value changes that is unrealized. And we're also looking at, you can say, the gain or loss which is realized. We're looking at the gain or loss which is realized in nature. Now, you need to be careful in which cases the concept of fair value changes are captured. In terms of AC, no fair value change. In terms of AC, no fair value change. In all of the cases, yes, it goes in OCI. Yes, it goes in P&L. Yes, it goes in OCI. Yes, it goes in P&L. So I think as the name is suggestive, FVTPL, then in the P&L, OCI, then in the OCI. So that's the change. AC, the fair value changes are not captured. Now comes the important thing. Realized gain or loss will go to the profit and loss. And OCI, here again, the realized gain or loss in the P&L. You can see unrealized and realized difference very clearly out here. And FVTPL, this is going to be P&L, of course. And what about this category? You tell me. So you've got equity investments. There is a realized gain or loss. Where are you going to put that capturing? I think that's a crucial point. So equity investments, where will you put this amount in this case? That's right. It is OCI. And in this case, it enters the P&L. So I think the only important element to be seen clearly is this case. I think this is the case which is important, circling it out. Because everywhere the realized gain or losses is entering in the P&L, this is the exception. So this is indirectly acting as an exception in this case. That makes a distinction in terms of equity investments. Let's add some more points now. Let's add some more points. So you need to be clear on the initial, on the EIR, the unrealized gain loss, the realized gain losses are captured in which place. Let's add something more to the chart. This is just summarizing all the inputs at one go. So let's take the particulars, and we've got 5 categories, 3 for the debt investments and 2 for the equity investments. So this is debt investments, and we've got equity investments. So let's take the categories. This is AC, FVTOCI, there is R, FVTPL, FVTOCI, there is NR, and it is FVTPL. Wow. Let's add some more inputs at this stage. Okay, now the next point is the point number 5. Now, in the point number 5, what I'm looking at is the dividends or the interest, as the case may be, which you are getting. So can I say, in terms of AC, you're going to get interest on EIR. So in this case, you're going to get the interest on EIR, and that's going to be taken in the profit and loss. In OCI, you're going to get the interest on EIR, and that's also going to be taken in the profit and loss. What about FVTPL? Are you going to take the interest on EIR, or are you going to take the actual interest in the P&L? Let's ask you that. If you've got a debt investments categorized as FVTPL, EIR does not apply. So are you going to capture the actual interest in the profit and loss in this case? So are we going to capture the actual interest because EIR does not apply? That's absolutely correct. So here we can say it is the actual interest which will be captured in the profit and loss. And in this case, you can say it is the dividends in the P&L. It is the dividends in the P&L. So the dividends will be taken in the P&L. So that's the dividends or the interest income captured. Now, the next issue which I have not covered so far, but I want to put it down at this stage. Because later when we come to the concept of impairment, I just want to document at this stage. So just to put it across at this particular stage. So I am putting the concept of impairment. We'll be talking of impairment later, so don't get worried. So impairment of financial assets. Yes, it is covered. Yes, it is covered. No, it is not covered. No, it is not covered. No, it is not covered. So we will see things, later as well. But I just want to pen this down at this stage, which cases the impairment gets covered. So you can see one thing very clear. You can see one thing very clear that FVTPL, in terms of FVTPL, there is no impairment done. There is no impairment which is done. It's already a fair value through P&L. But you can see in terms of OCI, see the contrast. See the contrast in life. And, let me say a few words at this stage, which I'll speak later. Here the fair value changes goes in OCI, and I want the impairment testing to be done so that I can take the impairment loss in the P&L. Here the fair value changes goes in OCI, but the standard setters did not touch this. The standard setters had a very clear-cut version. For equity investments OCI, I don't want anything to enter the P&L. I don't want anything to enter the P&L except the interest and dividends. So not even impairment is applicable. If you've got equity investments OCI, the fair value gain loss, unrealized OCI. The realized gain loss OCI. Impairment we've exempted so that nothing goes in the P&L. So nothing goes in the P&L in terms of equity investments. They created this concept that we'll not even touch it for impairment. But in terms of debt, it is being touched. So we'll talk of this later. But I want to pen this down so when you do the complete revision, your mind is very clear on certain focus points. So I think if you just take a quick run through. So we can see the initial measurements, the role of TC needs to be clear. The EIR applicable in which case needs to be clear. The fair value changes are captured in which place needs to be clear. The realized gain or loss is captured in which place needs to be clear. Which investment is covered by impairment or not needs to be clear. And the interest dividends, of course, goes in P&L, but whether it is actual or whether it is effective, that needs to be seen. Now let's get your comfort zone scores, friends. Based on the 5 cases which I have done now give me a comfort zone on a scale of 10. What is your comfort zone on the initial and subsequent accounting of all the 5 permutations, combinations in this case? Let's get the scores now. And then we'll take the journey forward to the next phase, 8. Great. And I'm yet to get more scores. I want you to give yourself scores, friends, at this stage. Yes, you need to revise this as well. But just look at the clarities because it's all about remembering what is taken which case. Where do you take EIR? Where do you take the unrealized gain loss? Where do you take the realized gain loss? What is initial measurements, TCs, etc. I think I'm getting some more scores to look at. So I think the next is 9 out of 10. The next is 9 out of 10. That's brilliant indeed. I think that's going wonderfully well. 9 out of 10. Superb. So far, so good. I think since morning, I have not done very technical discussions. I've just given you the inputs in terms of the 5 cases. Let's do one thing. Let's do a little more warm-up exercise before we get onto the technicalities. I am now going to go to some illustrations in the study material in unit number 2. Based on all this, let's have a look at some illustrations in this case. So I am going to consider, first of all, a few questions at this stage. Okay, so let's have a look at this. I think I'm going to the illustration number 22. I'm going to the illustration number 22. This is study material unit number 2. I hope this is visible. Right, clearly visible. Can we go ahead with this? I hope it is visible to all. Okay, that's wonderful. Then 10 out of 10, I'm getting a score as well. That's wonderful indeed. Superb. Okay, I've got a question. Sir, can you tell me how, in case of a non-derivative CFI, due to fixed number of shares from the issuer person, such instrument will be tested for SPPI? Since we've got the input from you regarding CFI, which due option the feature of the instrument? You said in terms of a non-derivative CFI, due to fixed number of shares from the issuer per se, such instrument will be tested for SPPI. Since we got the input from you regarding CFI, which is due option of the feature? Well, I think you're mixing two things. You're adding the option to convert and then you're saying non-derivative. I'm just a little mixed up with the input. But what I've understood out of your question is that when you've got a CFI, how is the SPPI test going to fail? Well, in terms of optionally convertible instrument, it would fail because you're not going to get solely cash in terms of principal and interest. But if it is, let's say, a non-derivative instruments, if you remember, when I documented the case of the CFI chart, I said generally the concept of CCSC, SPPI will fail. I did not say that in all the cases of CFI, the test will fail. So I think one has to evaluate that particular part, whether it is optionally convertible or any other kind of instruments. So let me again reiterate the point. CFI will always face a SPPI test? No. If you look at the chart, I also made a very clear-cut reference. Generally, it fails. There is one illustration in the study material pertaining to that CFI SPPI test as well, which we'll very shortly come to. So there is one illustration devoted to that part. So no worry, we'll be coming to that illustration also, right? Okay, so let's have a look at the illustration number 22 and let's apply the funda. It says accounting for the TC on initial and subsequent measurement of a financial asset which is measured at a fair value with changes in OCI. Now, this is illustration which is given in the appendix to the standard as well. An entity acquires a financial asset for currency unit 100 plus a commission of currency unit 2, that is TC. Initially, the entity recognizes the asset at 102 because on initial recognition, it is going to be added. On initial recognition, it is going to be added. Then he says the reporting period ends 1 day later when the quoted price is 100. If the asset was sold, a commission of 3 would be paid. This is a commission to be paid on sale. I'm not concerned. How would the TC be accounted in the books of the entity? Now, I think make a time scale to understand this better. What they're trying to explain in this illustration is the treatment of TC. This is T0 and this is T1. Though this T0 is just 1 day before, because it says that the entity acquired this asset and the reporting period ends 1 day later. So the reporting period is ending 1 day later. So say, for example, if your financial year is April to 31st March, then you can say you acquired the investment on 30th March. And we are sitting on 31st March. So he's telling me the treatment that you acquired the investment a day before the balance sheet date, and then you're sitting on the balance sheet date. Now, what we need to do? So you put the entry financial asset gets a debit and bank gets a credit. The TC will be added to the initial recognition because it is FVTOCI. So 100 is the fair value plus 2 is the TC. This is recorded at 102. Now, at the end of the year, it says the fair value is 100. Now, you would have paid a commission of 3. I'm not concerned. Because at the end of the year, I am supposed to record at a fair value. The TC is irrelevant at the end. So we know the fair value at the end of the year is supposed to be 100. So there is a decrease. So we're going to put this in other comprehensive income. OCI gets a debit and financial asset gets a credit. And this entry will be done with 2 rupees. Whatever is the change in the fair value that enters in the profit and loss, in the OCI. Now see the inputs given out here. The entity measures the asset at 100 without regard to the possible commission on sale and recognizes a loss of 2 in the OCI. So that's the 2 which is taken in the OCI. Now in this particular case, we are not concerned. Now, shall I tell you something which I can't prove, but should I tell you something which can be dangerous to your ears? You can stop me. You can say, no, I'll not say that. There is something which is given in this particular answer. The intention of taking this illustration number 22 was to tell you something. You can stop me and say, don't say that. I think everybody is, more or less stopped me on saying that. Okay, so I guess somebody said yes. Somebody said yes. Now, please hear this carefully. Just read this. If the financial asset is measured at FVTOCI, the TC is amortized to profit and loss using EIR. Oh my God. Oh my God. He's made some interesting input in this case. I like to tell you something, friends, at this stage. Just hear this, what he has written. He says that if a financial asset is measured at FVTOCI, we're talking about debt investments, the TC is amortized to P&L using the effective interest rate method in this case. Now, let me remind you one thing. Please hear this very carefully. You'll get the logic. Just watch this. Just watch this very carefully. I'm looking at a debt investments. I'm looking at a debt investments at FVTOCI. I'm looking at a debt investments FVTOCI. Now, I'm going to ask you a simple question. Please analyze this carefully. Because of the TC, does the EIR increase or decrease? Because of the TC, will the EIR increase or decrease? Tell me. When you're going to consider the TC and add it to the cost of the asset, so can I say because of the transaction cost, the EIR is going to go up or the EIR is going to go down? Remember, you need to calculate the EIR from the point of view of the investor. So if he says he invested 95, compared to you say, no, he invested 97. So with the more outflows and lesser inflows, the same inflow, is the EIR going to go up or is it going to go down? So I think that's right. So can I say because of the TC, the EIR will definitely decrease? If the EIR will decrease, can I say it will decrease the finance income? Is my thoughts correct? The finance income you would have got had there been no TC would have been greater. The finance income now you will get because of the TC will go down. So can I say indirectly the TC goes to the P&L in the form of reduced income over the period of time. Let me put this again. So can I say when you consider a TC, the TC is going to reduce the effective interest rate. And that because of that reduction, the interest income will go down. So indirectly, your TC is getting amortized. Can I say it is getting amortized by way of reduced finance income each year. So I think that's what he wants to say, that it is amortized to the profit and loss using the effective interest rate. And that is the concept that the TC in this case has impacted the EIR. So indirectly, the finance income goes down. So the TC is indirectly getting adjusted against that reduced finance income over a period of time. I hope I made sense. Okay, so this is done. Now I think let's go further. I think somebody asked me a question on that. So I think let's have a look at this. I think the question which somebody asked me in this case, I guess the question which came from someone, I'll just tell you, you will now get your answer on what you were asking. This question, I think I just forgot. Somebody just put a very good question. I forgot your name. I think I just missed it. Maybe. I think somebody asked me a question. I'm just going to show you back on that question. Just look at this. This is meant for your question. Now, let's have a look in this particular case. Illustration number 24. What's the illustration number 24 in this particular case? I think you were talking in terms of something which is optionally convertible. So partially answers your question. Let's have a look. It says Silver made an investment in optionally convertible preference shares, OCPS, a bronze limited at 100 per share with a face value 100. Silver has got the option to convert the OCPS into equity shares 1:1, and if such option is not exercised till the end of 9 years, then it is redeemable at the end of 10 years at a premium of 20%. Analyze the measurement of this investment in the books of Silver. I think that is something which you asked, something which is compound. This is going to be a compound financial instruments with a derivative embedded. Whether it will be segregated or not from the issuer perspective will depend upon the fixed for fixed test. But I think you'll agree that if I look at this instrument from the point of view of the issuer, it is undoubtedly a CFI. Because in this particular case, when you're giving an option, in this particular case, we always have the presumption that the coupon rate given is going to be less as compared to a coupon rate on a non-convertible preference share. Now let's have a look. The classification of the financial asset is done based on two characteristics: whether the contractual cash flow comprising solely payment of principal and interest. So this is the CCFC comprising SPPI test. And then it says entity's business model managing the financial assets, whether it is to collect the cash flows or it involves realization of both the contractual cash flows and the sale of the financial assets. This is the business model test. Now you know this very carefully. You know this very well, that as far as debt investments are concerned, the step number 2 is CCFC comprising SPPI test. And the step number 3 is supposed to be the business model test. So he's very generically written to you that you need to apply the CCFC test, you need to apply the business model test to evaluate. Now see what it says. In the above cases, the holder can realize the return either through conversion or redemption at the end of 10 years. Hence, it does not indicate that contractual cash flows that are solely the payment of principal and interest. Did you get the point? Remember when I showed you the concept of CCFC, when I said if you're considering an optionally convertible instrument, in this particular case, since you will realize a return by conversion into shares or by taking a cash, you are not getting solely cash. You are not getting solely the principal and the interest in cash, because it is by cash or by conversion as the case may be. And therefore it says that this test will fail. If this test will fail, it is carried at FVTPL. That's what I've given you. Accordingly, the investment shall be measured at a fair value, and periodically the gains or losses will be taken in the profit and loss. I think somebody asked me a question. Did you get your answer on that? What you were asking, I think I missed your name in between. So did you get the inputs that why did I said that optionally convertible instruments, which is a CFI from the issuer perspective, generally will fail the concept of CCFC SPPI test. I'm not saying all compound financial instruments will fail that, but you can say those instruments which are optionally convertible will end up failing this particular test because of the option given to the holder, where you can take a cash, where you can take the take the conversion into shares, and the concept of solely gets failed in this case. Okay, I didn't get a message from your end. I don't know whether you got the answer on that or not. Okay, anyway, so I think this is done. Now we are going to go back. Now let's come back on the agenda. I want to add now some more inputs at this stage. Now we're moving towards our next area of discussions. We're still on financial assets. I've given you the 5 cases on financial assets, 3 for debt investments and 2 for equity investments. Now we are coming back on the picture where we said initial recognition, where we said the initial recognition is done at a fair value. And now we need to understand that if there is a difference in the fair value and the transaction value at the initial recognition, how do we take care? So I'm going to take you to another very interesting chart which is given in the study material, and we start working on that because this is now a chain we need to work upon detail. So let me first share a chart in the study material on this area. So this chart we have already covered. There's another interesting chart, and yes, this is the chart. Let's, I think, have a look at this. This is on the initial measurement and a wonderful chart which summarizes the concept. So what's this? We are now going to work upon the special issue. Let me remind you, we are on the special issue on the initial part. Okay, I think I got a message. Let me see if that comes on the same one. Yes, yes, I got it. But I asked the question specifically from the instrument which is a CFI because of fixed number of shares along with the mandatory invest income. Okay, I got your point. Fortunately, unfortunately, there are many permutations and combinations which can take place, and the accounting of all those permutation combinations, fortunately, unfortunately, is not covered in the, in the books as well. So I think it's difficult to make a walkthrough on that area, how it will be dealt with, because when you're looking at a CFI, an instrument which is CFI, but it's non-derivative in nature, and in that particular case, I can only just conceptually give it to you. And if you say that in this particular case, the CCSC FC SPPI test is passing, then you would apply a business model and consider that. Because in those particular cases, you'll have to evaluate the business model. You'll go to the next step. Because in this particular case, if it is non-derivative in nature, but let me tell you, if you say it is mandatorily convertible, in those particular cases also the CCFC SPPI test will fail. If you say it is partially convertible, in those cases also it will fail. I think you'll catch my point, that if it is a case of mandatory convertible, you'll fail the test. If it is partially convertible, you're going to fail the test. If it is optionally convertible, you're going to fail the test. And whenever the fixed test is getting passed also, you will fail the test. The only situation where a non-derivative instruments will pass the test is when you are going to give variable number of shares, and in that case, it'll automatically become a financial liability. In those particular cases, I think I can't even imagine that it becomes a CFI. So my input is that in most of the cases, if it is CFI, mind the words, in most of the cases, if it is CFI, you will land up the CCFC test failing. I hope you get the point on that. So I think in most of the cases, if you're trying to look into the point, it's going to be variable number of shares. In those cases, I don't think so it'll become a CFI as well. I think in those cases, it'll become a case of a financial liability. So my mind is that, if I look at most of the instruments which are CFI nature, I think the CCFC test will fail. I think you get the answer on that. Maybe. Great. Wonderful indeed. Okay, now let's come on to the next agenda with you. So I am now covering a special issue, friends, with you. We are covering a special issue with reference to the financial assets, and that is when the fair value is not equal to the transaction price at the initial recognition. then how do you tackle the difference between the fair value and the TP? So I'm going to give you a brief first of all. We'll just spend around 5-7 minutes on this discussion, then we'll take a break and then start working more in detail. But just have a first look on the chart. It says initial measurement, instrument is at market terms, or the instrument is at off-market terms. Please hear me very carefully. You'll get the entire inputs very shortly by the end of the class today, but I'm just first creating an image in your mind. As we said, that financial assets initially are measured at a fair value. And I said, if there is a difference in the fair value and the transaction price, how do you account for the difference? So let me put it now the other way around. There will be a difference in the fair value and a transaction price only if the transaction is at off-market terms. So what do you mean by off-market terms? I'll give you a very simple example. Let's say I'm an employer and I gave a loan to my employees. I said the market rate of interest is 10%, but you are my employees. I'm going to give you a concession loan and I'll give you interest at the rate of 6%. So I charge interest as an employer, which is 6% as compared to the market rate of interest, which is 10%. And that's what is called an off-market transaction. Trust me, if I am giving a loan to someone at 10% and that is the market rate itself, then there is no favor. If there is no favor, the transaction price and fair value will be same. Let me put this in a mathematical form. Let me put this in a mathematical form as well. Let's take a very simple example to understand the simple concept of fair value and a transaction price. So let's take a timeline and consider two examples. Let's consider a simple timeline and consider two simple examples and understand this with time value of money. Let's say, for example, I made an investment, or let's say I gave a loan to someone. I gave a loan to someone at time zero, and that's, let's say, 1,000 rupees. I said that after 1 year, you need to pay me a 10% interest. So how much is he going to pay you at the end of the first year? He'll pay you 1,000 plus a 10% interest, and that is 1,100. Now let's consider the transaction is at market terms. When I say the transaction is at market terms, this means this is the contracted rate and this is the market rate as well. This is the contracted rate and this is the market rate as well. I charged a 10% interest to someone, which is the market rate of interest. No favors. No favors. It's at market term. Now, if you want to calculate a fair value, we can say whatever is the present value of this money, that is the fair value. Now, when you took the fair value, I took the fair value at the market rate of interest, which is 10%. Since the compounding took place at 10% and the discounting took place at 10%, mind the words. Since the compounding took place at 10% and the discounting took place at 10%, you can see this is the transaction price. The transaction price and the fair value is the same. So if you charge somebody interest at market terms, that means you charge compound at market rate, and then the fair value is the present value at the market rate. So if the contracted rate and the market rate is same, the transaction price and fair value is same, because you're compounding at the same rate and you're discounting at the same rate. So if you compound and discount at the same rate, the TP, the transaction price and the fair value is going to be same. So this is called at market terms. This is called at market terms. But let's imagine if it is off market terms. Let's imagine if it is off market terms, then what is the input? So for example, I told my employees the market rate of interest is 10% and I will charge you, let's say, 6%. So in this example, what will happen? So let's say if you gave a loan to someone at 1,000 rupees and you said that I'm going to charge you interest. You said I'm going to charge you interest at 6%. This is the contracted rate. So you will tell the person that on 1,000, pay me 60, that is 1,060. But when you calculate the fair value, you will take the present value at market rate. You're going to consider the present value at the market rate. So if I were to calculate a fair value, I would take this 1,060 discounted at the market rate. Remember, the fair value is supposed to be the present value of the future receipt. It is the present value of the future receipt. So in this case, I will discount 1,060 divided by 1.1. It comes to 964. This is the fair value and this is the transaction price, and there is a difference of 36. There is a difference of 36. This is called the difference between a transaction price and the fair value. Don't take this as an equity component which you took in case of issuer. I'm looking at the holder's perspective. I'm looking at the holder's perspective. So in this particular case, the transaction price and the fair value is different. And this is called off-market transaction. So your first focus is to see that is the contracted rate and market rate same. If the contracted rate and market rate is same, it is called at market transactions, in which case the TP and the fair value 100% will be same. But if the contracted rate is different as compared to the market rate, it is called off-market transactions. In this case, the TP and the fair value will not match. And if the TP and the fair value will not match, we need to see where do we take this 36, because the entry will be financial asset debit 964. I'll capture the financial assets at a fair value. The bank gets a credit to the extent of transaction price. So where do we take the difference of 36? That is the agenda. So I hope you got the input that you need to see is the transaction at market terms, then TP and fair value is same. If it is off market terms, then TP and fair value is not different. Then you debit the financial asset with the fair value, you credit the bank with the TP, then what do you do with the difference is what we need to decide. I hope you got the basic agenda of the thoughts. So what we're going to do, we are going to work upon this. How to identify transactions are at market or off market terms. How do we tackle the difference is accounted how? But we're going to do that, I think, after the break. Let's, I think, first give you a relaxation of minds and then I think begin the journey. So let's give you a break, friends, first of all, 10, 12 minutes. And then we're going to extensively discuss this special issue. How do we identify off-market terms? How do we account for the difference? Let's take a break. Enjoy your break. ब्रेक लगा दीजिए. Friends, I hope you had a relaxation of mind. So let me remind you what we were discussing before the break. I was basically giving you the inputs in terms of that once you record a transaction at a fair value, that means your initial recognition of the financial asset is done at a fair value. There could be a difference in the transaction value, or you call it as a transaction price, whatever, vis-a-vis the fair value. So how do you tackle the difference is the agenda. So just to connect the dots once again, what you need to broadly see is two things. Is the transaction at market terms? When I say at market terms, that means the contracted rate and the market rate is same. In that case, the transaction value and the fair value undoubtedly will be same. Mathematically, why so? Because you are paying interest compounding at market rate and then you discount at a market rate. Because what is the transaction value at which you record a transaction, at which you enter into the transaction? And what is the fair value? The present value of the future amounts. The present value of the future inflow is the fair value. And since the contracted and the market rate is same, your transaction fair value will always be the same. But the problem comes when a transaction is entered into at off-market terms. The contracted rate is less as compared to the market rate, in which case your fair value definitely will be less. The fair value will definitely be less as compared to the transaction price. And how do we account for the difference is the agenda. So on that input, let's get back to the chart. So let's have a look at this chart, which is given in the study material in the unit number 2. So it says the first thing to see is that the instrument is at market term. Now, if the instrument is at market terms, it says capture it at transaction price, because as I said, the transaction price will be definitely equal to the fair value in this case. But if it is at off-market terms, we need to get the fair value. How will I get the fair value? I will take the present value of all the future cash inflows. I'll take the present value of all the future cash inflows in this case. And then it says, now, how do you tackle the difference between the fair value and the TP? Because in this case, the transaction price will be greater as compared to fair value. So there will be a difference. Now, let me explain. Because what I am now telling you is something based on Ind AS 113. Yes, you heard me correct. I'm talking in terms of Ind AS 113, which is called fair value measurement. Now, if you refer to Ind AS 113 fair value measurements, do you have an idea, friends, on the fair value concept? 113 yet to do the standard? I don't know. So, are you aware of the concept of 113, level 1, level 2, level 3 inputs, or do I need to explain that to you? I don't know if you've done this standard or not. So, do I need to illustrate that to you? Any inputs on that? So, I think I got some inputs. Okay, yet to do. Okay, not an issue. So I think I'll give you some basic insights on the concept of 113 only to the extent I require in the standard. Now, when you consider a fair value in 113, there are basically, you can say, called hierarchy of inputs. The calculation of the fair value considers something which is called a fair value hierarchy. It's called level 1, it's called level 2, as well as level 3. So you can say indirectly, what goes in the calculation of the fair value is the input data. So we need to see that that input data is level 1, 2, or 3. There's no fourth level, it's only level 3. Now, what is level 1, level 2, level 3? Let's take a very basic example to illustrate the point to you. Let's say, for example, I invested in equity shares of a company. Now, I invested in the equity shares of a company which is listed on the stock exchange. So since I've invested in the equity share of a company which is listed on a stock exchange, I can get the fair value from that stock exchange itself. It is something which you can say is observable data, because everybody can observe the fair value which is prevailing on the stock exchange. And you can say it is a very reliable data as well. Because when you're looking at a level 1 data, it is something which is directly observable. Because it is quoted on the stock exchange, it is directly observable. And at the same time, it is reliable in nature. That's one. Now let's take a second case. Let's say I invested in an equity share of a company. Now that share is not listed on the stock exchange. But let's say a similar share, a similar company share is listed on a stock exchange. So it's a similar share. It's not exactly the same share. It's an identical company whose shares are listed on the stock exchange. Now, I would say this is not directly observable. It is observable, but it's not directly related to the investment you've made. So what we can do is we can make some adjustments. We can take the fair value of that identical equity shares and make some adjustments and get the valuation done. And that is called level 2 data. So when it is directly observable, it's level 1, which doesn't require any kind of adjustments. But when you are taking a value of an identical investment, it is supposed to be made some adjustments. It is observable, but requires certain changes, and that's called level 2 data. But sometimes, let's take a third example, you invested in the equity share of a company which is not quoted on the stock exchange. Even a similar company, identical shares are not quoted in the stock exchange. So in those cases, what you'll do, you'll take some data based on some assumptions. You basically maybe use something what we call a DCF technique, a discounted cash flow technique, make some projections based on certain growth assumptions, etc. And all that data is something unobservable in nature. And when it becomes unobservable in nature, the reliability of the data also goes down. And that is called a level 3 input. So Indus 113 makes a distinction in terms of that when you consider a fair value, either you take a data from, you can say, level 1, which is directly observable in nature. Or you take a data which is observable, but it is identical asset. It's not something which is directly related, but it is observable. The reliability slightly goes down, but still reliable in nature. And then comes the data number 3, which is level 3, which is based on unobservable data. And even Indus 113 very clearly says that this is a case which is, unreliable in nature. So every company is required to make a disclosures in accordance with Indus 107 that when you've captured the fair value, let's say of the financial assets, you need to make a notes in the notes to accounts that, whichever fair value is taken, is that a level 1 data, is this a level 2 data, or is this a level 3 data? So in any case, when a company is going to consider the fair value is going to be based on one of the 3 levels of input. The caution, what I'm telling you, unless mentioned otherwise, I'm going to consider that the fair value data is level 3. Because there will be some information in the question. But in most of the cases, if you consider, let's say, a loan given by a parent to a subsidiary, or a concession loan given to the employees by the employer. So all these cases, you will see that we will land up considering and taking the presumption that it's a level 3 data. But you need to read the question very carefully and see if he's giving you any insights regarding the fact that the fair value is based on observable or is it based on unobservable inputs. I hope I'm clear on my thoughts. I hope you got the inputs clear that what is level 1, 2, 3. So when I say it is directly observable, level 1. When I say it is observable, something which is identical, it's level 2. And when I say it is unobservable, it is level 3. Now see what it says. It says if the fair value is based on level 1 input or a valuation technique that uses only data from observable markets. So I would say if the fair valuation is based on observable data, instead of saying that it is based on a level 1, let's say if the fair value is based on observable data, that is 1. Any other basis would mean that it is unobservable data. And accordingly, the accounting treatment will follow. It says if it is observable data, the difference between the fair value and the transaction price is taken in P&L, and this is by virtue of Ind AS 113. This is by virtue of Ind AS 113. It's called day one gain or day one loss, as the case may be. So if a company is considering the fair valuation on an observable level of inputs directly, or you can say it is something which is identical in nature, observable data, any difference in the transaction value and the fair value is going to be taken immediately in the profit and loss, and that's called day one gain or loss. So we tell the company that you made an investment in a security which is more than the fair value. Your transaction price is more than the fair value. That's a bad game. When you knew that this is the observable data, then why did you make an amount? Why did you invest money in an amount which is much more as compared to the fair value? So you're indirectly penalizing the company and telling them that if you're going to enter into a transaction price more than the fair value, then I'm going to immediately take a hit on your P&L. And that's called a day one gain or loss. But there is a possibility that when you're entering into transactions, the calculations of the fair value, which is based on unobservable data, differs from the value at which you transact. It is bust obvious. Then I cannot blame the company and say that, you take the entire difference in terms of P&L. In those particular cases, the standard says the difference between the fair value and the transaction price is taken in one of the two. It says it is asset if it qualifies to be, otherwise it is amortized to P&L over a period of time. So either it is captured as an asset and it doesn't get into the P&L, or it is captured and then it is slowly and steadily transferred and amortized to the P&L. Now, in which cases will you capture the difference in the asset? In which cases will you amortize that amount to the P&L? That's what I'm going to give you a walkthrough now. We're going to look at a couple of illustrations and we're going to see that is this difference going to be an asset? Is this difference going to be amortized to the P&L over a period of time? So I would now say I'll convert this entire exercise into a three-step model. So again, three-step model. Yes, I'm going to put this entire exercise in a three-step model. Now, what we're going to do in this case, step number one, you need to identify, is the transaction at market terms or is it off market terms? If it is at market terms, then the transaction price and fair value is same, done. If it is off market terms, you go to the step number two. You go to the step number two and identify what is the source of the fair value. Is it observable or is it unobservable? If it is observable, then the difference in the transaction price and the fair value goes to the P&L immediately. It's called a day one gain or loss. And if you say it is unobservable, you go to the step number three. Now, what we're going to do in step number three, we're going to look at the transaction. And I'll document that part later. Now I'm working on step three. So what is the inputs? I'll document the steps later. In step number one, you need to see, is it at market terms or off market term? If it is off market terms, you go to the step number two. Is the fair value based on observable, unobservable data? If it is observable, day one gain loss. If it is unobservable, then you go to the step number three. Now we're looking at the step number three, which are the transactions where I'm going to call this as an asset, which are the transactions where I am going to amortize that in the P&L in the future period of time. So I'm now going to show you a few questions which I've taken from the past examination questions as well as from the RTPs and all. We're going to look at this particular aspect. Let's go ahead. We'll come back. We'll document the charts. No worry. So I'm just added a few questions which I'm going to just share on the screen to you, and we're just going to have a look at them. So let me, first come to November 2020 examination question, which came for 12 marks in the exam. So we're not solving this question right now. We're just looking and reading at this question. Let's have a look at the question number 3 on the screen. This is November 2020 examination question. Let's read. It says on 1st April 2020, S advanced a housing loan to one of its employees at an interest rate 6% per annum. And then I'm just going below. I'm just taking a jump and going below. It says out here in the end. It says in the end out here as far as the interest, in the first para. It says the market rate of similar loan is supposed to be 10% per annum. So we have given a loan at the rate of 6%, that is contracted rate, and the market rate on similar kinds of loan is supposed to be 10%. So when you look at the data, that the contracted rate is different as compared to market. And trust me, you're not going to see a situation where the contracted rate is more than market. No. Either it is equal or the CR is less. So in this case, when you see that the contracted rate is less as compared to the market rate, it means it is an off-market transactions in this case. And if it is an off-market transaction, the next thing to be seen is that is it observable or unobservable. Now, I believe that these kinds of concession loans, and when it says, that market rate for similar loans for housing finance by banks. Now, you're looking at loans which are given by the banks to the public. And here I'm looking at a loan which is given by a company to an employee. So in any case, I would not say that this is a directly observable data. I would say it would be something which is, maybe adjusted. And if it is adjusted, there might be some significant adjustments. And trust me, when you make significant adjustments to a level 2 data, this is definitely, I would say, a level 2 kind of data where you've got similar kind of loans. But you need to see that one is a loan by a corporate to another corporate. And the other one is supposed to be a loan by a corporate to an individual. So in this particular case, the safest assumption would be to go that if you're going to make significant changes to the level 2 data, it's going to become level 3. So that means it is unobservable. And in this particular case, if you say that it is based on a level 3 data, if it is based on a level 3 data in this particular case, we can say, where do we take the difference? The difference is going to be taken as a prepaid staff expense. You can indirectly saying that it is you can say perquisite which an employer has given to the employee. Because when you're telling the employee that I will give you interest at the rate of 6%, whereas the market rate of interest is 10%, you're indirectly giving him a perquisite value. So what I'm going to do in this case, the difference between the transaction price and the fair value is a prepaid staff expense. And that prepaid staff expense will be amortized over the profit and loss account over the period of the loan. Remember where he said that the difference is either treated as an asset or it is amortized over the P&L. So if you see in a question that there is a concession loan by the employer to the employee, you're going to treat that as a prepaid staff cost, and the difference is going to be taken amortized over the P&L over the period of the loan. How do we solve that question? That's later. This was one kind of relationship. So what is coming in the mind is that you can see that there could be an employer-employee relationships and resulting in off-market transactions. If there is an employer-employee relationship resulting in an off-market transaction and it's a case of a concession loan, you can treat this as a prepaid staff cost, which is going to be amortized over the period of 5 years. In this case, whatever is the period of the loan. Don't worry, we'll document that later. Let's have a look at another question. This is another question which came in November 2019, examination question, 4 marks. So we'll be solving these questions also very soon. I'm just first making a walkthrough on the 3-step inputs. It says A made a security deposit whose details are given below. Make necessary entries for the deposit. Assume that the market rate of interest for a similar period is 12% per annum. And I think if you look at the details of the deposit, it's a deposit made for a period of 5 years and I am not given any interest. The contracted rate is supposed to be 0. And the market rate in this case is supposed to be at the rate of 12%. So the contracted rate is nil and the market rate is 12%. It is definitely an off-market transaction again. Because on similar kind of deposits, we pay interest at the rate of 12%. But in this case, I am not getting any interest as let's say, a lessee. When I made a deposit, I am not getting any amount of interest in this case. Now, how do you tackle this particular case? Now, I would say the second kind of relationship which you're going to see, I'm working on the step number 3, where in step number 3, I'll start looking at the type of relationships and that will decide my accounting. The first kind of relationship I gave you is an employer-employee resulting in a concession loan. The second kind of transactions which you're going to look at is, you can say, a customer-supplier. It's a customer-supplier relationship where the supplier wants you to make a security deposit and the customer makes a security deposit in this case. In this case, it's a lease transaction between the customer-supplier, or you can say the lessor-lessee. Because initially, in terms of Ind AS 116, you call the lessor and the lessee as a supplier and a customer. Once it is identified as a lease, you call them as a lessor-lessee. So this deposit from the lessee's point of view is going to be adjusted in the right of use asset. So what we're going to do in this particular case, the difference in the transaction price and the fair value is going to be captured in the right of use asset, and then that amount will also be amortized over the period of life of the asset. That is the depreciable life of the asset, which you decide on the basis of Ind AS 116. So when you reach a conclusion that the transaction, the relationship in this transaction is of a lessor-lessee, the difference is going to be adjusted in the right of use asset, which is to be depreciated over a period of the depreciable life. Because the depreciable life may be equal to lease term or may be equal to useful life. That depends upon the parameters of 116. That is second kind of relationship. So are you going to give us an exhaustive list of relationships where this difference will be considered? Well, from an examination point of view, yes. Because if you look at the questions which are there in the study material, which have come in the past examinations and the RTP, I see that they're basically dealing in terms of 3 kinds of relationship. Either it is an employer-employee relationship resulting in concession loans, or it is a case of lessor-lessee, which results in a case of security deposit with either a 0 rate of interest or maybe with negligible rate of interest. Let's have a look now at another third transaction. Oh my God. Too technical for the board to digest as well. It got mixed up. I hope the file gets saved. Sometimes there is a danger as well. So now we're going to look at the third kind of transaction. And let me tell you in advance, that third kind of transaction is supposed to be a parent-subsidiary relationship, where the parent would make some investments in the subsidiary and that could also result in differences. Let me just go back and take you to the third example of a parent-subsidiary relationship in this case. Let's, I think, have a look at this. So this is also an examination question which came in May 2018. So all 3 examination questions, this came in May 2018. Let's have a look at this. It says Ish issued redeemable preference shares to the holding company. So the holding company made an investment in these preference shares. So we're given the period is 3 years and the preference shares. The dividend rate which is given is practically 0. And the market rate of interest is supposed to be 12%. So we can say the contracted rate is less than the market rate. So this again means it is an off-market transactions in this case. Now, there is bound to be transactions between the parent and subsidiary where the subsidiary issues some kind of securities and the parent makes an investment in those securities. So what do I do with this? That means the subsidiary is not giving me returns. They're not giving me dividends. So I am basically giving them money without expecting anything back in return. So this will be called as a deemed equity investments which you have made in the subsidiary. So this is going to be the first case where the difference is going to be treated as an asset in the books of the parent company. You're going to take the difference as a deemed equity investment because you are supposed to get 12% and they are giving you nothing. So moral of the story. Moral of the story, if I just correlate my 3 steps, the step number 1 is to see that is the transaction at market terms or off market terms. How do you compare that? If the contracted rate is equal to the market rate, it's at market term. In those cases, the transaction price and fair value is same. Second, if it is off market terms, when would that happen? When the contracted rate is less as compared to the market rate. You go to step number 2. In step number 2, you need to see that is the data picked up from observable inputs. If it is picked up from observable inputs, then the difference in transaction price and fair value is taken to the P&L immediately. It's called a day 1 gain or loss. But if you say the data is picked up from unobservable inputs, you go to step number 3. In step number 3, per se, you could look at 3 kind of relationships. Employer-employee resulting in a concession loan. The difference is a prepaid staff cost. The second is a case of lessor-lessee relationship, security deposits made where there is no interest received and that will be adjusted to the ROU asset. And the third case is the parent-subsidiary relationship, in which case it will be taken as a deemed equity investments, which is not to be amortized over the period. It's going to remain as an equity investment, a deemed equity investments. But let me also tell you another interesting input on which there has been examination questions as well. This entire concept of transaction value and a fair value difference does not apply in terms of trade receivable and in terms of loans which are recoverable on demand. If there is any loans even between the parent subsidiary which is classified to be loan recoverable and payable on demand, the concept of transaction price and a fair value concept would not apply. So you need to be careful. Just don't look at the relationship first. You also need to be very careful that this entire section of discussion is applicable to all financial assets except trade receivable, except loan which is recoverable, payable on demand. I hope I am clear with my thoughts. Now I'm going to document all this to you and then we'll start looking into each and every category. So let's, I think, pen the thoughts down. So coming back to the chart, so I'm just going to pen this down out here, just below the chart itself. Okay, so let's, I think, put it out here. Let's pen down the 3-step model out here. So we're looking at a 3-step model. We're looking at a 3-step model, and this is with reference to when the transaction price is not equal to fair value. So let me also first of all pinpoint that these steps are not applicable. These steps are not applicable to number 1, trade receivable, and number 2, which is a loan which is recoverable on demand. Even though it is supposed to be between related parties, do not consider this concept. So let's, I think, begin with the step number 1. So in the first step number 1, what we'll do is the transaction. Is the transaction at or off market terms? So we're going to first put across a question, is the transaction at or is it off market terms? That is the first input which we need to watch out. So in this case, there will be 2 cases. So in this case, there will be 2 cases. So we can say the 2 cases are, number 1, it is at market terms. It is at market terms, or we can say it is off market terms. So either it is at market terms or it is off market terms. How do you identify that it is at or off market terms? By comparing the CR and the MR. The CR is equal to MR. Just to make a mention, the CR is the contracted rate. The CR is supposed to be the contracted rate and the MR is supposed to be the market rate. And this will be very clearly given in the question. You don't need to worry on this. And in this particular case, if it is off market terms, you will see the contracted rate is definitely less as compared to the market rate. So in the first case, when it is equal, you can say fair value is equal to the transaction price itself. So we can say there will be no difference. There will be no difference on initial recognition. There will be no difference on the initial recognition. Debits and credits will match. But in this particular case, what we'll do, we'll go to the step number 2. In this case, we go to the step number 2. So the first focus is only to consider that is the transaction at or is it off market terms, as simple as that. Then we go to the step number 2. Then we go to the step number 2, and in terms of step number 2, we need to see the level. Rather, let me not say level, rather let me say what is the inputs. What is the inputs level, input of fair value? So what is the level of input? Is it observable or is it unobservable? So is it observable in nature or is it supposed to be unobservable in nature? So is the inputs observable or unobservable? If you say it is observable, then we can say the difference between the transaction price and fair value. This is going to be treated as a day one gain or loss. It will be treated as day one gain or loss, and it will be taken in profit and loss immediately. It is going to be taken in the profit and loss on an immediate basis, day one gain or loss. And if it is supposed to be unobservable in nature, then it's time to go to the step number 3 and look at the type of relationship. That is step number 2, looking at the data, the input points. Is it observable or is it unobservable in nature? And then we go to the step number 3. And I would say in terms of step number 3, you can look into the type of relationship. You can look into the type of relationship. I'm not saying that this is an exhaustive list of relationship, but I'm saying that in most of the questions, if you see, you'll see more or less they fall into these 3 kinds of relationship. So we'll see mainly 3 kinds of relationship in this case. You will see the relationship is in terms of employer-employee. The relationship is in terms of employer-employee, and the transaction in this case, and the accounting treatment in this case. So we'll see the inputs. So we can say in this particular case, when you see the transaction, it would be a concessional loan. It'll be a concessional loan. And if it is supposed to be a concessional loan, when we are going to treat this, the difference is prepaid staff cost. It is going to be treated as a prepaid staff cost. And this prepaid staff cost will be amortized. This will be amortized on straight line method over the period of loan. So this will be amortized on a straight line basis over the period of the loan. So we will amortize this difference over the period of the loan. The next one is supposed to be, we can say lessor-lessee relationship. And if you're looking at a lessor-lessee relationship, This will be in terms of a security deposit. This could be a security deposit by lessee. It could be a security deposit by lessee, and this could be at 0% interest maybe, that you deposit and deposit, which is with a 0% interest. So what do you do with the difference in the transaction and the fair value? So this difference is going to be treated as ROU asset. We're going to put this difference in the ROU asset. And what will you do with this ROU asset? So this will be amortized. This is going to be amortized, or we can say depreciated. This is going to be amortized, or we can say depreciated over the depreciable life. Is going to be depreciated over the depreciable life of ROU asset. So we will basically spread it over, depreciate it over the ROU asset life. The life of the asset depreciation would be decided as per Ind AS 116. And then the other kind of relationship which we're going to see is, you can see the parent-subsidiary relationship. Is going to be a parent-subsidiary relationship. And this could be parent investing in subsidiary. The parent investing in subsidiary at 0% returns, practically at 0% return. But remember, this should not be a case of loan payable on recoverable on demand. So don't just see that case. If it is a case of exception, this chart does not apply. So you need to see that he's investing for a long tenure. So the parent investing in a subsidiary at 0% return. So here, the difference is going to be called as a deemed equity investment. We're going to call this as a deemed equity investment, and this will not get amortized. This will not get amortized, so this will remain as it is. This is getting amortized in the form of depreciations. This is getting amortized in the life of the loan, but this will remain as it is. Right, friends, I hope I am very clear on the differences between TP and the fair value, how we're going to proceed with the three-step model on this. So what we're doing is right now, just to remind you, on a special case. We are on a special case in this particular case. In this particular case, when you're looking at a special case where the transaction value is different. Okay, I got a question. So what is the principle based on which we need to consider it asset or amortized? What is the principle based on which we need to consider it as asset or amortized? I think now you would have got the answer. That, typically you'll have to see the kind of relationship, parent, subsidiary, employer, employee, lessor, lessee. And on that basis, we will consider where the differences is going to get parked. Right? I hope that answers your question now. Okay, so what we're going to do now, you know how many questions I'm going to do. I'm going to do these 3 questions with you. One by one, we're going to go to the questions on a concession loan. Then we're going to go to the questions on the security deposits. And then we're going to go to the questions in terms of holding and subsidy. Once we're done with all these 3 questions, this special issue will get done. Today, we are doing our deep dive PhD in terms of financial assets accounting. Oh, wow. Okay, so let's, I think, take the journey forward. Great. Clear so far, so good. So I think let me just come back on the very first example which I showed you. That is an examination question. So let's come back on this. Let's have a look now on question number 3, which is on the concession loan November 2020 examination question. Let's now read the question in entirety and then we'll solve. Let's read this first. It says on 1st April 2020, S advanced a housing loan 15 lakhs to one of its employees at an interest rate 6%, which is payable in 5 equal annual installments along with interest at each year end. Now, many people tend to get confused on this language. And they start thinking that is this the principal in 5 equal installments, or is it the principal with interest in 5 equal installments, which is called EAI, equated annual installment. So let me tell you, when the word is written along with means plus interest. So we need to interpret the language that you're paying the money in 5 equal installments of principal, and then you're also going to pay plus the interest. So this is paid not in 5 equated installments, but this is going to be paid in 5 equal principal installments of the loan. Then he says employee is not required to give any specific performance against this benefit. So this is a perquisite value, but we are not requiring the employee to give us any kind of service in return. So that does not make a difference. Even if you require a specific performance or you do not require a specific performance, the accounting treatment does not undergo a change. And then it says the market rate of interest is 10% per annum. The accountant or the company recognized the staff loan in the balance sheet equal to the amount of the loan disbursed, that is 15 lakhs. So that is an incorrect treatment, because the initial recognition of the asset should be done at a fair value. Then he says interest income for the year is recorded at the contracted rate in the statement of P&L. So he's taken 6% on 15 lakhs, that is 90. So the entire accounting done by the accountant is incorrect. The initial recognition is wrong. The calculation of the interest income is also incorrect. Analyze whether the above accounting treatment made by the accountant is in compliance with the relevant Ind AS. If not, of course it is not, advise the correct treatment of the housing loans, interest and other expenses, that is the prepaid staff cost, in the financial statements for the year 2021, first year, along with the workings and applicable Ind AS. You're required to explain how the housing loan should be reflected in the Ind AS compliant balance sheet of S Limited on 31st March 21. So I think let's first of all look at the initial entry and then we'll see the inputs further. Let's solve this question. Answer to the question number 3. So you can definitely give the explanations in detail to the examiner. Tell him that it's an off-market transaction, the contracted rate and the market rate of interest is different. Explain that this will lead to a difference in TP and a fair value. Give them the initial entries and so on. So let's organize the data. So my contracted rate is 6%. So we can say the contracted rate is 6%. The market rate is 10%. And that gives us the conclusion that it is off-market transactions. It is an off-market transaction. And then we can go on to the fact that it is supposed to be an employer-employee relationship. It is supposed to be an employer-employee relationship, and which is on account of a concession loan, So we need to first of all get the fair value. So I think this now involves a lot of calculations. How would we calculate the fair value? So let's first make a working note number 1. So we're going to first make a working note number 1. This is the fair value computation. This is the fair value computation for initial recognition. So we need the fair value for the initial recognition of the financial assets. Now, what is the fair value? As I said earlier, the fair value is the present value of all the inflows I'm going to get as an employer, the equated principal for the next 5 years and the interest. So let's do one thing. Let's make a chart. Let's take the year. So year number 1, 2, 3, 4, 5. And let's take the cash inflows on account of both the interest and the principal. And we will then take a discounting of this money. So we'll take a PVIF and get the present value. The discounting in this case is going to be at the market rate, that is 10%, and we get the present value. Now this is going to be simple. I guess if I'm looking at the calculation of the principal, 15 lakhs is the loan and it's paid in 5 equal installments, 3 lakhs each. So you can say the principal is going to be 3 lakhs every year. So we will receive 3 lakhs as a principal installment every year. And then you can take the interest on the outstanding balance, which is at the rate of 6%. So can I say on 15 lakhs, 6% interest is going to be 90? And let me, I think, quickly ask you something. Can I reduce this interest by 1/5 every year? Because if the principal is getting repaid in 5 equal installments, the outstanding principal will keep declining by 1/5. So can I say the interest will also decline by 1/5 consecutively? Correct. So that's right. So this can be reduced by 18,000 every year. 1/5 is 18,000. So keep reducing this by 18,000 every year. So this is the principal and the interest which we are going to receive. So let's take the discounting at the rate of 10%. That's 0.909. That's 0.826. That's 0.751, 683, and 621. Now let's get the present value of all this amount as well. So let's now consider the present value. This is 390. This is 354,510. This is 307,272. This is 265,854. That's 229,488. And this comes to 197,478. And just add this up. This is the fair value at the initial recognition. So let's take the sum total of this, 229,488. I think this is coming to 13,54,602. Just see the calculations are correct. 13,54,602. This is the present value of all the future inflows from the employer's perspective. So we can now put the journal entry at the inception. So can I say, if I look at the entry at initial recognition, the entry at initial recognition in this case is financial assets will get a debit, which is loan. And this loan is going to be captured at a fair value, 13,54,602. That is supposed to be the fair value. And we record the entry bank. And this is with the credit. This is with the transaction price, which is 15 lakhs. So now you can clearly notice that the loan is getting captured at the fair value. The bank is getting captured at the transaction price. So we're going to get a balancing figure in this entry. And can I say the balancing figure in this entry is going to be what? Is going to be called as a prepaid staff cost. So the balancing figure is the prepaid staff cost, which we need to amortize over the period of next 5 years, straight line. So this is going to be 15 lakhs minus 13,54,602. So this comes to 145,398. Okay, so this is the entry which is done at the initial recognition. I think the question is asking us to do the accounting for the first year. So I think I'm just going to show the inputs at the end of first year and maybe show the extract financials as well. So this is the initial recognition. Now let's see the entries as far as subsequent accounting is concerned. So let's see the entries on the subsequent measurement. I'll just show 1 year. Similar entries will be made at the end of each year and show you maybe the extract financials in terms of balance sheet, how would things look like? Because it's a 12-marker examination question. So you need to very carefully tell the examiner, it's a good idea that you show the accounting entries or maybe make leisure accounts. and then you must show the extract financials, what appears in the extract balance sheet or extract P&L. That would be a good idea. Okay, so on the subsequent part, that is on 31st March, so I think I'll prefer to make a ledger account. That would be easy. So by the way, let me also ask you that this financial asset, can I call it as a debt investments accounted at AC? Because when you're looking at subsequent accounting, the subsequent accounting would depend upon, it's a proper loan. So where you get the contractual right to receive the principal and the interest. And can I say it would be, of course, till maturity, because you would collect the contractual cash flows from the employee for the next 5 years till maturity. So can I say it will be accounted as a debt investments at AC? Is the thoughts correct? Yes, that's right. So we need to consider this in terms of this. Sir, I have a question relating to issuer, but will you once complete the discussion? Okay, no worry. We'll take your questions later. Not an issue. So this is going to be accounted at amortized cost approach. So let's record this. Financial asset gets recorded. This is bank with the fair value. This is 1354,602. So we'll attribute the finance income at what rate? The rate at which you do the discounting, you're going to do the compounding at the same rate. So that's going to be at 10%. So this is 135,460. And you receive something at the end of first year, which you can see from this chart. So can I say you're going to receive 3,90,000 at the end? So this comes to 3,90,000 at the end. And we get the balance CD as a balancing figure. Now, I want to show you something more interesting at this stage as well. And I think that's very important when you're going to make the extract balance sheet. Is this loan going to appear as a non-current asset in the balance sheet? The answer is no. There is a portion of this loan which is current in nature. So it will be a good idea that when you make the balance sheet and reflect this loan, you should show the non-current and the current portion separately. So how am I going to do that? Make 1 year extra ledger account to segregate the detail. So what we're going to do, let's make the extension of this ledger. Let's make an extension of this ledger and I'll show you what is the current and the non-current portion. So this balancing figure works out at, I think, 11,00,062. So this becomes a balance BD 11,00,062. Again, you take the finance income at the rate of 10%, 11,006. And then you receive the money, and this is going to be 3,72,000 for the second year. And we get the balance CD. So though the question is asking the entries at the end of first year, but I made a ledger account for 2 years because I want to segregate the current and the non-current portions as well. So plus 11,006 minus 372. This comes to 838,068. And I think now let me say something. I think you'll easily vouch me for this. Can I say if I were to segregate from the balance sheet point of view, that as far as the loan is concerned, what is the current and the non-current portion? If I want to segregate the current and non-current, can I say this is the non-current portion, which is, recoverable after 1 year. So this portion, that is 838,068 is non-current. And can I say this difference is what we can say is current? Because this is the balance CD this year, this is the balance CD in the next year. So this difference will get recovered within a period of 1 year. So we take that difference, 11,062 minus 838,068. So we can say 261,994, that becomes current. So in the balance sheet also, show the financial asset, the current and non-current on a segregated basis. It makes sense. Okay. Now, I think let's go to the next area. Now comes the case of this prepaid staff cost, which is supposed to be amortized. Over 5 years on straight line. So this is going to be amortized over 5 years on straight line. So 145,398 divided by 5. So it's approximately 29080 approximately. Which means even this prepaid staff cost will be segregated in the balance sheet. Even the prepaid staff cost will be segregated in the balance sheet between non-current as well as current in nature. So let's, I think, do that as well. So can I say out of this 145,398, this is the annual amortization of the current year. So what is the balance CD at the year one end? So out of this, this is the amortization done. Let's see the balance which is left over. 145,398 minus 29080. This is 116,318. But this is again a total of current and non-current combined. So what is the current portion? What you'll amortize in 1 year? So 29080 is the current portion. And what is the non-current? 116,318 minus 29080. That becomes the non-current portion. So it will be a good idea to segregate the element what is current and non-current to the portion in the balance sheet. A balance sheet extract makes good sense. If you want, you can make a P&L extract as well, reflect the finance income and the amortization of the prepaid staff cost. That can also be done. Now, this is going to be 87. This is going to be 87,238. That is the amount. Right, friends. So I think this is done. That's what the question was asking us. He was saying you're required to explain the loans and make a compliant in this balance sheet as well. So I've not shown the entire details in the balance sheet, but you know that you need to reflect the current and non-current. So that makes it a good question. Accounting from the initial to the subsequent with the blend of off-market transactions all put together. One case is done. So this is case one, the case of a concession loan by the employer to the employee. We'll have 2 more questions to go on this. One is on the lessor-lessee relationship. One is on the parent-subsidiary relationship, which will continue. And then comes our inputs in terms of accounting for financial liabilities with you. So financial assets more or less over. Then we'll go on to the next level, and that is accounting in terms of financial liabilities. I think that seems to be quite good for the day. I think somebody had questions to ask. Yes, please go ahead. You want to use your mic to put the question across? Okay, I think I got a question. So I have a question from the issuer perspective. In case of optionally convertible debenture, if the option is with the issuer, then how the accounting will be done in such a case? Interest rate is higher than the rate suits to the risk profile of the issuer. And do we have to consider the redemption amount for the purpose of measurement of the option? Okay, I'll give you the practical viewpoint, though it may not be relevant from the exam point of view. But since you put the question across, let me tell you. If you say the option is with the issuer, so let me assume that it's a compound financial instrument. Let's assume it's a compound financial instrument. Now, I'll tell you what will happen. If the issuer gets the right to convert, it's a financial asset for the issuer. You heard me correct. In this particular case, what I will do, I'll segregate the financial liability and the equity component, and I will segregate the financial asset component. This option which is there with the issuer becomes a financial asset, a contractual right for the issuer. So you'll have to go to the valuer and get this derivative financial asset valued. So say for example, if the proceeds, the proceeds in this particular case is, let's say, 10 lakh. Let's say the proceed is 10 lakh and the amount of derivative financial asset valued is, let's say, to the extent of 1 lakh. Let's say the financial liability is valued at 8 lakhs. So your equity becomes a balancing figure, and this balancing figure is going to be 3 lakhs. 8 plus 3, 11 minus 1, 10. I hope you got the point. So 8 plus 3, 11, that's on the liability side, minus 1, that makes it 10. So it'll be 8 plus 3 minus that 1, and that's how you're going to get the proceeds of 10. So if you're looking at an issuer perspective, then you'll get a derivative financial asset in this case, if it is a CFI. I think you would have got your answer on that. And so very well explained. Thank you. Thank you very much indeed on that. And so what is investment by subsidy to the parent at off-market terms? See, for example, a subsidy issued, we yet to do that question, they issued some kind of securities and the parent invested in those securities. Now, when he invested in those particular securities, then the subsidy may not pay the return, the dividends or the interest at market term. So they will end up getting, you can say, no coupon rate or maybe less than the market rate of interest. So there seems to be an off-market transaction where the subsidy is entering into a deal with the parent and he is not giving return at market terms. He is giving you a dividend or interest below market terms. It becomes an off-market transaction, which means the parent has indirectly, put in money in the form of equity investments in the subsidy. That's the case we are yet to cover on that. Right. I think that answers the question. I think your question also gets answered on this part, I guess. So, but if interest rate is higher in this case, if we discount without conversion option, well, generally that cannot be the case. Generally, why would I pay an interest in which particular case the interest is much more than the non-convertible? I don't deny the possibility, but then, you'll have to look at the facts. I think from the examination point of view, I have not seen any of this question of this sort as well. You will not see this kind of things, being asked extensively because this derivative value, if it is given, it has to be stated in the question. Because I can't value this derivative. This derivative value is to be done using a Black-Scholes model. And in this particular case, then the examiner has to tell you derivative financial asset. Then, technically speaking, there is nothing left for me to do. Because in this particular case, I know the derivative financial assets. I just need to get the FL and the equity organized and go for. So generally, you'll see that most of the questions which are asked are with the option with the holder and the perception in the issuer takes a little backseat from the examination point of view, I would say. Right. Right. Does that answer your question, I think, Krishnakant? Okay, so we'll see post exams. Many things you're going to see post exams as well, because this is just a tip of the iceberg. When you apply things practically, it'll take a next levels, of course. Right, friends. So I think time to bid goodbye to you. So see you in the next class. So please remember to revise all what we've done today. We're going to carry on the trail of discussions in the next class with you. Thank you very much. Bye-bye and take care. Haji, thank you. Same to you. Thank you.